What is going on, my friends? Ryan Williams here, back with another one. And in today's video, we are going to be talking about the best dividend stocks to buy in November of 2021. Now, today we will be covering 4 different dividend paying companies that look like pretty good buys in the upcoming month. And just so you guys know my criteria, I chose these 4 specific stocks based on how they're currently valued, how they've been performing recently, and also because of their dividend stats, which I am very excited to get into with you because we have some really good dividend paying companies on the roster for today. Also, later on in this video, I'm going to be going through and answering a couple of your guys' questions on the topic of individual stocks versus ETFs and on the topic of diversification, so be sure to stick around for those. And before we get rocking and rolling, if you guys are stoked to talk about some dividend stocks today, then go ahead and give this video a big thumbs up. And if dividend stocks is something you're really into, then I'd ask you to consider subscribing to my channel as well. On this channel, we strictly talk about dividend stocks, and I upload videos on the topic of dividend stocks every Wednesday and every Sunday, so there's a lot of good dividend stock content coming your way, and I would love to have each and every one of you along for my dividend investing journey. Anyway, thank you so much for doing that, and now, without further ado, let's get into it. All right, my friends, now the first stock that I think is going to be a good buy in the upcoming month of November is Cardinal Health, ticker symbol CAH. Now, for those of you who are not familiar with this company, Cardinal Health is a distributor of pharmaceuticals and a manufacturer of medical and lab products. And I'll tell you guys what, this stock is looking like it is priced to be a really good buy right now. As you can see in the last year, it is up 2.5%, which is pretty much nothing. In the last 6 months, it's down over 20%, which is wild. And then in the last month, it is down another 3.88%. So it is trending down as far as the share price goes. And if we're looking at the PE ratio here, this does indicate some affordability, 8.44, so that's pretty cheap. And if we scroll down real quick, let's take a look at what some of the Seeking Alpha bulls are saying about CAH. And also, guys, this is probably a good time for me to announce I am currently on a 14-day free trial of Seeking Alpha Premium. I figure I'm on this website enough, and I just wanted to try out some of the premium features. And I gotta say, so far, I'm really digging it. There's a lot of cool things like what the bulls and bears say. And more than anything, I'm really excited to have unlimited access to all of the articles and news and analyses on any single stock on this website. So that's been huge. I've been catching up on a lot of good dividend stock information. So anyways, back to CAH, what the bulls are saying. So CAH may be the ideal name for those who seek deep value combined with high yield. Management plans to repurchase shares, which could return significant value to shareholders. Okay, that sounds pretty good. All right, moving on to the second one, a low valuation coupled with a consistently growing business and a low valuation will eventually lead the way towards a higher valuation. Okay, that's nice to hear. Number 3, even when considering rather low growth rates for Cardinal Health going forward, the stock is still undervalued and we get a solid company in a dividend aristocrat. All right, this all sounds pretty good, guys. And as far as the stock being a dividend aristocrat, that is awesome as well. We'll take more of a look at that in just a moment. But for now, let's scroll up and take a deeper dive into the stock's current valuation. So we talked about the PE ratio a little bit, with the forward PE ratio being 8.44, which is 22% lower than this stock's 5-year average, so that's nice. If we scroll down and take a look at this stock's price to book, it is kind of up there, 58% higher than its 5-year average, sitting at 7.70, but they do have a really nice price to free cash flow of 5.21, which is 30% lower than the 5-year average. Anything in the single digits for this number here is something we're looking for, guys, and CAH definitely hits that mark, so that's good to see. All right, guys, now scrolling up, let's take a look at some of the numbers behind this company's growth. So scrolling all the way down here, let's first take a look at the revenue. We can see pretty much across all time periods, year over year, 3 years, 5 year, 10 years, the stock is going up in revenue. But if we look at this levered free cash flow, which is a pretty important number for us dividend investors, we can see that across all time periods, it is down. Okay, year over year, this levered free cash flow is down 81%. And upon seeing this, guys, I deployed some of the perks that I get from this Seeking Alpha Premium trial, and I read some of the articles and analyses on this stock. And one that I found from this writer, Jen Alpha, explains what is going on with the levered free cash flow pretty well. So this article reads, of course, no dividend aristocrat is going to fall from the graces of the market without having near-term challenges to work through. While revenue grew by 16% year over year during the fiscal fourth quarter, operating earnings dropped 40% year over year. With the pharmaceutical segment profit flat compared to last year, the decline in operating earnings was driven by a medical segment loss of $63 million during the fourth quarter due to an inventory reserve on certain PPE products and elevated supply chain costs. So I would keep an eye on this right here, guys. The author of the article we just read did call this a near-term problem, so It could be something temporary for this company, but at any rate, this number is important because if the levered free cash flow is not there or decreasing, then dividend growth or dividend payments seem less likely as we make our way into the future. So with that said, let's scroll up now and actually take a look at the dividend. So okay, the forward dividend yield of this company is looking pretty good, right at 4%. And the payout ratio is pretty low, 33.7%, which does bring some comfort considering what we just saw with that levered free cash flow. They still do have some room to contribute more to this dividend, but if their free cash flow is in the negative, at least for the near term, it's good that they're keeping this payout ratio pretty low. The 5-year growth rate, guys, is 3.16%, which is really not the highest. At this point, that's not even beating inflation. But the number of years of dividend growth for this company are very nice. 25 consecutive years, which, like we've read, makes this a dividend aristocrat. And then sticking to the topic of the dividend, guys, if we scroll up, let's take a look at this dividend safety page right here. I just wanted to see what rating Seeking Alpha gave to this dividend, and it looks like they give the safety an A-, which is pretty good considering what we just saw with that levered free cash flow. So if that at all was concerning, not that this A- grade means a whole bunch or is the end all be all, it is comforting to see that they still consider this dividend pretty safe. All right, guys, now moving on to the second stock of the day, we have Bristol Myers Squibb, ticker symbol BMY. And if you guys saw my last monthly best dividend stocks to buy video for the month of October, you guys will have seen this company, and I gotta tell you what, it is looking like an even better buy now than it was 1 month ago. So just in the last month, this stock has lost another 4.18%, which brings this PE ratio down 7.74. That is extremely low, guys. And just for kicks and giggles, guys, let's take a look at the share price performance across some other time periods real quick before we move on. So in the last 6 months, BMY is down 12.83%. And then we saw it earlier, but in the last year, it's down 3.7%. So the stock has really come down. It looks like at its highest in the last year, it was at $69.20 or about 69 bucks. And that was not too long ago, actually, back towards the end of August. And then it just, man, it really went down. That's crazy. But anyway, guys, let's scroll down. Let's take a look see what some of the Seeking Alpha bulls are saying about Bristol Myers Squibb. So the first one here says, at 7.4 times earnings, BMY is 40% undervalued and priced for a negative 2.2% CAGR growth, while analysts expect 4 to 9% long-term growth, creating the potential for a triple in 5 years. Moving on, given BMY's track record of profitability, growth, and stability, current stock price is simply too low. The current price represents 15 to 30% upside. All right, moving on to number 3, strong moat and secular support in the long term. Short term supported by a yield spread close to the widest level of the historical spectrum, signaling favorable odds for large returns. Okay, that sounds pretty good as well. Now, before we move on and look at some of this company's valuation metrics, I want to point your attention to the right-hand side of the screen where it gives a little summary of this stock's dividends, basically all of the dividend stats: safety, growth, yield, and consistency, and the lowest score here is a B-. So our friends over at Seeking Alpha consider the dividend on this stock to be pretty good. Now let's go over to the valuation page and check out some of those metrics. So the first one we want to look at is the PE, which, like we saw earlier, is 7.74 and is 43% lower than its 5-year average, which is nice. It looks like the 5-year average PE ratio for BMY is 13.73. So it's in the single digits right now. It's very low. It's almost half as low as this number right here. And then scrolling down, taking a look at the forward price to book, that's 3.56, which honestly, I'd like to see that a little bit lower, but we have seen higher price to books in other stocks. The price to cash flow is looking pretty good as well, 7.81. All right, guys, now scrolling up, let's take a look at the revenue and free cash flow to see how that's growing. And if we scroll down, we can see that pretty much across all time periods, this company is spot on with revenue growth. 10 years, its compounded annual growth rate is 8.11. And then across all the other time periods, year over year, across the last 3 years, across the last 5 years, BMY has grown their revenue by over 20% compounded, which is wild. And then taking a look at the levered free cash flow, guys, it looks like this last year was negative, down 40% levered free cash flow. But then across the last 3 years, 5 years, and 10 years, these compound rates are all looking pretty good. 41% compounded growth across the last 3 years. That's really nice. Over 25% compounded growth across the last 5 years, and then almost 8% in the last 10 years. All right, now let's scroll up and see what all the hubbub is about with this company's dividend. Why is it getting such good ratings? So Let's scroll down here. Forward dividend yield, 3.39%. Okay, not too shabby, guys, not too shabby. A very safe payout ratio of 26.24, so they have a lot of room to grow. And this low payout ratio is good when they do have negative free cash flow years like they did year over year. Okay, the 5-year growth rate, 5.22%. That's not too shabby. I think that is right at about where inflation is right now. I think it's 5.4%, the last that I heard. And then BMY has a dividend growth history of 12 years. And if we scroll up here, take a look at the dividend history. Okay, so they've been growing their dividend for 12 years, but they've been paying their dividends for 31 consecutive years. And I want to zoom out on this dividend history chart here and just take a look at that slope. Looks like it's about 3 times higher today than it was back in 1990. So in the last 30 years, this dividend has more than tripled, which is really cool to see. Almost quadrupled, actually. All right, now moving on to the third dividend stock that I think will be a pretty good buy in the month of November. That is Omega Healthcare Investors, Inc., ticker symbol OHI. Now, for those of you who have never heard of this company, OHI is a real estate investment trust. It's a REIT that operates in the healthcare industry, and the buildings that they own are primarily things like skilled nursing facilities or nursing homes or assisted living facilities, stuff like that. And like I said, this is looking like a pretty good REIT to get into right now. So in the last year, they're only up 3%. In the last 6 months, they're down almost 20% in share price. And then in the last month, they're down just barely 0.67%. If we zoom out a little bit farther, let's take a look at kind of what the share price has been doing across 5 years. So right before all the craziness started back in 2020, it looks like this stock was trading at about $45 a share, somewhere in that range. And then it dipped down at its lowest to, where is that? See if we can get that, $14 a share. Oh my goodness, could you imagine picking this stock up at $14 a share? That'd be wild. But has since made its way back up to about 30 bucks a share and is now in a decline again, going back down from about 35, 36, and even touching into the 20s. The lowest it got recently was, mid $29 per share range. And at its current price, guys, it is looking pretty affordable. It has a forward P to FFO, which stands for price to funds from operation, of 9.35. And this is a metric that we use in place of the PE ratio for real estate investment trusts. But you can analyze it in the same way. A 9.35 P to FFO is really good in the same way that a single digit PE ratio is really good. Now let's do as we've done with the last couple posts and scroll down and see what the bulls are saying about this company right here. So the first one here says, I recently pointed out to them that OHI's biggest risk right now is a dividend cut, and that's probably already priced in. And this is something that we are going to take a look at in just a moment because they don't have much of a dividend history right now, but like I said, we'll take a look at that. Number 2 says, an asset plus dividend valuation method suggests OHI is attractively valued at its current price, offering a good opportunity to buy a quality business under today's overall expensive market. Moving on to number 3, OHI has long-term potential as an increasing need for its properties become more in demand. And you know what, let's take a look and see what the one sole bear has to say about OHI. So this person says, stock is trading at a significant premium to NAV, net asset value, despite operator risks. Okay, so this might be worth reading more into to figure out what these operator risks are. But we'll save that for another video, guys. Let's scroll up and take a look at the dividends. Now remember, before we go over there, remember this person mentioned a dividend cut being a risk. So let's take a look at the dividend here. So before we get into the yield and all that stuff, they do have 0 years of dividend growth. So this is kind of what I think that one bull was talking about, but we'll touch more on that in just a moment. So the forward dividend yield is 8.67%, which is extremely high, guys, extremely high. I should have included this on my last video talking about the best ultra high yield dividend stocks to buy right now. And real quick, if you guys have not seen that video, definitely check it out. I'll include the link to it in the description. It was a really fun one to make, and everyone loves high yield dividend stocks. So definitely check that video out and let me know what you think. Moving on, this company has a payout ratio of 81.03%, which is not concerning. Real estate investment trusts do always have higher payout ratios, and that's because they have to pay out a lot of their earnings to us as shareholders. So don't freak out when you see this 81% payout ratio. Moving on, OHI has a 5-year growth rate of 3.02%, which is pretty low, but they have a really high forward yield. So there's kind of a trade-off there, okay? And then obviously no dividend growth history pretty much. But if we go over to the dividend history page, we can see they have been paying their dividend for 17 consecutive years, which is pretty good. And if we zoom out, let's zoom out at a maximum here, guys. When did they stop growing their dividend? It has to have been recently, right? Just looking at all these, it just looks like between 2019 and now they have not grown their dividend. So they haven't cut their dividend at all. It looks like they just stopped growing it starting in 2019, in October 2019, basically 2 years ago. Moving on, let's go up and look at some of the growth metrics for this company. Let's scroll down and take a look at their revenue and free cash flow. So this is all looking pretty good, okay? So just as far as the revenue goes, across the last 10 years, they have a compound annual growth rate of 12.5%. So this revenue is growing pretty steadily year over year, save for the last 12 months, guys, where they are actually down 7.5% in revenue, but this is just a one-off thing. And then across all time periods, levered free cash flow looks amazing. Year over year growth of 56%, 3 years compound growth rate of 10%, same with 5 years, and then a compound growth rate of over 16% in the last 10 years. Now, going back to the summary page real quick, guys, just some closing thoughts on OHI before we move on to the fourth stock. I'm not personally invested in this company. I don't have plans to invest in this company, but if I was looking for a real estate investment trust, I would consider adding this one to my portfolio. The only negative to this stock, as far as I can see so far, guys, is the lack of dividend growth history. But even with that, I'm sure that some of you out there will have a place for a stock like this in your portfolio. Anyway, those are just some closing thoughts I had on this company. Now, let's move on to the next one. All right, now the fourth and final stock that I think is looking like a pretty good buy in the upcoming month of November is Verizon, ticker symbol VZ now. And I won't spend too much time talking about this one, guys, because I'm sure you have heard about it from pretty much every other content creator in this space like 10 times already. A lot of other people have been talking pretty heavily in their videos about how good of a buy Verizon is, and I think they are all correct. I mean, this is a really good company. This is a legacy telecom company with a huge market cap of over $220 billion. And something is going on sector-wide right now to bring all these telecom stocks down. As you can see on the screen, we took a look at this chart in my last video, but this shows the share price performance in the last 3 months of the 3 big players in the telecom space, AT&T, Verizon, and T-Mobile. Now, as you can see, Verizon is right here in the purple, and in the last 3 months has dropped over 10%, compared to AT&T's 8.06% and T-Mobile's whopping 21.44%. But still, a 10% drop is nothing to scoff at, guys. And with that said, Verizon is looking better than it has in some time and is looking like a pretty good pickup right now. And to validate that a little bit more, let's go take a look at the valuation here. So Verizon has a forward PE ratio of 9.92, which is about 17% lower than the 5-year average of 11.93. So it is lower than average. And the forward price to book here is looking pretty nice as well, 2.74 compared to the 5-year average of 4.48, which is almost a 40% reduction. And then lastly, the price to free cash flow is looking perfect, 5.68, which is also lower than the 5-year average of 6.58 by about 14%. So anything in the single digits really is looking good as far as the price to free cash flow, but it's also good to compare it to where it is on average. And it's good to see it lower than average, which means you can get the stock for a lower price and a more affordable price than maybe you otherwise would. Now, scrolling up, let's just take a quick look at the dividends, guys. Verizon is a pretty good dividend payer and has a forward dividend yield of 4.79%, a payout ratio that I think is looking pretty good, 47.58%, a 5-year dividend growth rate of 2.11%, which is really low. I'm not gonna lie, that is pretty low, but the 4.79% yield is good to see, and they do have a dividend growth history of 8 years, which is also good to see. And if we click over to the dividend history, we can see that they do have 21 consecutive years of dividend payments under their belt. So although they've been growing it for 8, they have been paying it for over 2 times as long. And if we zoom out here, yeah, look at that, guys. Looking pretty good. Looking pretty good there. And going back to the summary page, guys, just some closing thoughts on Verizon. This is a stock that I'm currently actively buying. I've now bought shares of this stock for the last 2 weeks in a row, and I probably will continue to buy it for at least another week or at least another couple of weeks. And my actual position with the stock is in the red. I think, actually, if we look on Seeking Alpha, we can see that. So if we go over here, go over to holdings, you guys can see that my Verizon position right now is currently down 6.09%. So with each new purchase, I am decreasing my average cost per share, which is pretty good. It's always good to get stocks for a lower price than where you initially entered at. So that's what I'm doing right now with Verizon, and we'll continue to do so while it's still affordable. All right, guys, now moving on to the next segment in this video, we are gonna get into a little bit of a Q&A. And this is something I'd like to actually start working into every single one of the videos I upload on Wednesdays. On Sundays, I'm doing weekly portfolio updates. On Wednesdays, I want to take the time to answer some of your guys' questions because I get a lot of really good questions in the comment section of my videos. And although I do make an effort to respond to you guys directly in the comment section, there are some others out there who probably don't read the comments and maybe have some of these same questions as well. So I do think it will be beneficial to answer these on camera. And I also think it's going to be a lot of fun. So let's get into the first comment from Taylor Green, who wants to know, Ryan, What made you decide to invest in dividend stocks compared to just investing in ETFs like VTI or VU? Of course, I know the dividends come into play, but mostly asking why you decided to invest that way over ETFs, just a set it and forget it kind of way. And the answer is pretty simple, to be honest with you guys. I just really like spending time with these dividend stocks. In the couple years now that I've been actively investing in dividend stocks, I've really come to enjoy learning more about the companies themselves and learning about how to analyze them. I feel like I've learned a lot of good financial skills just from starting to learn how to analyze these dividend stocks. And I also like the idea of building my portfolio from scratch and being able to customize it with stocks that I think are good investments. And I'm not always going to be right, but even the ones that I'm wrong on, there's a learning experience to be found there. So I feel like that's important, especially for someone like me who has a lot of years left to invest. I have a lot of years to be doing this, and it's just really fun for me. This has become somewhat of a hobby of mine and ties in perfectly to making these videos. I'd have a lot less to talk about if I wasn't investing in individual stocks and was just investing in ETFs every single week, every single month. I don't feel like I'd have a lot to talk about in these videos. And with that said, I don't think there's anything wrong with ETFs. I think at the end of the day, it just depends what type of person you are and how hands-on you want to be with your investments. And like I said, this is something that I consider fun, so I don't really mind doing it. That was a great question, Taylor. Thank you so much for asking. I feel like this is one I could probably ramble and rant on for quite some time. But in general, I just have a lot of fun doing this and I like learning more about this stuff. So that's why I choose to stick with individual stocks. And moving on, the next question comes from RxDog1984 who asks, do you typically aim for 4.5% on all your positions, or is it weighted more towards higher yielding positions? Also, what would be your ideal percentage range for a single position? Thanks. So the short answer to this question is no, I don't typically aim for 4.5% on every single position. It really just depends. I have some stocks in my portfolio that I've allocated more of a position to, and I have some that I have allocated less of a position to. And to show you some examples, as you guys can see on the screen, I have some stocks that are like in the 4%, my AT&T is in the 7% range, Starbucks is 6%, Chevron is 5%, so it really just depends, but I do say the general rule of thumb that I maintain is to not have any single stock be more than 10% of my total portfolio. And from there, it just depends how each sector is allocated in my portfolio as well, because I do go by target allocations per sector. So for example, consumer staples is a certain percentage of my portfolio, communications is a certain percentage of my portfolio, and I build the stocks within those sectors to add up to that target allocation, if that makes sense. That's another really good question, and if you'd like for me to go more in depth on that, I can certainly do so in another video. Just let me know in the comments below. But otherwise, guys, that's pretty much all I got for you for today's video. So thank you so much for watching and sticking around till the end if you are still here with me. I know this was another relatively long video. And if you guys have some more questions for me to answer in the next Wednesday video, go ahead and leave those in the comments below. And while you're at it, let me know your thoughts on the 4 stocks we talked about today that I think are good buys for the month of November. Do you guys have any of these in your portfolio? Are any of them on your watch list? Do you currently own any of them? Let me know in the comments below. And with that said, I will now get out of your guys' hair, but thank you once again so much for watching this video. I really appreciate it. Hope you guys have a great day, and I will see you in the next one.